press the bell icon on the YouTube app and never miss another update.
So let me ask you a simple question. And that's the reason I was smiling, because the question is, if you are investing in a bond, if you are investing in a bond, what is the risk that you are undertaking? Do you feel you are taking any risk by investing your money in a bond? What do you say? Any risk? Okay, forget about bond. Let us say you invest in a fixed deposit with State Bank of India. Tell me, what is the risk? Is there any risk when you put money in FD with SBI? Is there any risk? Or do you feel it is risk free, that there is no risk at all? Actually, the discussion is with respect to bond, but then as I said, if bond is a bit difficult, let me give you a simple example. Fixed deposit is something that perhaps every household in India has, isn't it? So you have put some money in the fixed deposit with SBI. I'm just asking you, what is the risk that you are taking? Now, don't tell me that the risk will be what if SBI goes broke, SBI becomes bankrupt. I'm not talking about that. That's a very extreme situation. If SBI becomes bankrupt, understand, if SBI becomes bankrupt, then perhaps it's the end of the Indian economy. Okay. End of Indian economy. That is the thing. So I'm not talking about that extreme case that SBI is going bankrupt. That's the risk. No. SBI will remain sound. SBI will remain healthy only. I just want to know, in that situation, what is the risk when you put money in FD? Or do you feel there is no risk at all? My money is safe. There's no risk at all. What do you say? Okay, let me put it in this way, and then I'm sure you will be able to guess it. You are putting money in FD with SBI, and SBI is offering 6% interest. 6% interest. You know what is the risk? Now I'm sure you will be able to understand it. What is the risk? Risk is not of losing the money, that something happens with SBI. SBI goes into liquidation and I don't get any of my money back. No, we are not suggesting that. The risk which is there is with respect to fluctuation in the interest rate. Okay, I put my money today at a rate of 6%, and after 2 days, SBI revises its rates and says that new fixed deposits will be now available at 8%. You put your money at 6%, and now the rate becomes 8%. That is the risk that we are taking. This risk is what is referred as interest rate fluctuation risk. Okay, interest rate fluctuation risk, or I can simply say interest rate risk. That is also possible. So rates of interest will fluctuate. That is the risk that you are undertaking when you put your money in a fixed deposit. I invest today. I'm very happy that now maybe for the next 5 years, I'll keep on earning at 6%. And just within few days, the rates are hiked, the rates increase, and now I'm going to suffer a loss because the new FD will pay me 8% while I am stuck with the old FD of 6%. Of course, you can withdraw the money from that FD and you can again make a fresh investment. All those things are possible, but that is possible if it is a fixed deposit. That won't be possible if it is a bond. Okay, that will not be possible if it is a bond. Why? Why will that not be possible? Because in a bond, if the yield will increase, see, in a bond, if the yield will increase, we know yield and bond prices are inversely related. Okay, the moment the yield will increase, the bond prices will crash. So even if you are selling the bond, you will have to sell the bond at a loss. I can withdraw easily money from fixed deposit, and then if my FD is paying only 6%, I will close that FD and I will invest at 8%. I'm assuming that there will not be any penalty. Nowadays, usually there are no penalties on premature withdrawal, assuming that you are not going to lose much in an FD. But in a bond, there is a good chance of losing money. You will lose in terms of interest. You will also lose in terms of capital appreciation, especially if the bond is listed, the bond prices will crash, and that is where you will be booking a loss. You may wonder, why am I discussing all the things about interest rate fluctuation? Because that is necessary to understand this new concept of duration, or Macaulay duration. This concept of duration has been, what I can say, developed by Frederick Macaulay. So we can even call it as the Macaulay duration. What duration does is, duration protects you from interest rate fluctuation risk. This is really necessary. Understand this. Why are we investing in bonds and not in shares? Okay, let me put it in this way. Why are we investing in bonds and not in shares? We do not put money in shares. A lot of people will not put money in shares because they will counter argue that, see, in shares there is a lot of risk. There is a risk of losing money. And because there is risk of losing money in shares, that is the reason I invested in a bond. And now you are telling me that in bond also there is a risk. You get my point? See, if I always wanted to take risk, I could have definitely invested in shares. But that's the reason I don't want to take that risk. That's the reason I invested my money in a bond. And now I realize that in bond also interest rate fluctuation risk is there. So risk is there even over here. I will definitely like to take steps by which I can mitigate this particular risk. That's where we have the concept of duration. If you remain invested for a period equal to the duration of the bond, you will remain protected from interest rate fluctuation risk. For example, for example, there is a 5-year bond. There is a 5-year bond. And let's say duration is 4 years. Duration is 4 years. Tenure of the bond is 5 years, but duration, let's say we do our calculation and duration turns out to be 4 years. If you are putting your money in this bond, do not remain invested for 5 years. Do not remain invested in short for the entire tenure. Remain invested only for 4 years. If you remain invested for a period equal to 4 years, you will not suffer from interest rate fluctuation risk. Whatever is the original yield on the basis of which you invested in the bond, that original yield will be available to you as an investor. Getting it? So that is what basically is the background for the concept of duration, right? See, I should be motivated to do some calculation. If I just tell you this is how duration will be calculated, okay, fine. But why will I calculate it? What is the reason that as an investor I will ever attempt to calculate the duration? Now I realize that as an investor, if I put money in a bond, I may suffer from interest rate fluctuation risk. I want to protect myself from that risk. And because I want to protect myself from the risk, I am now asking myself that how can I really do it so? And now I realize I can do it by remaining invested for a period equal to the duration of the bond. Right? Okay. Now, of course, we discuss the main thing, right? What do we really mean by duration? Let's figure that thing out now, that what exactly do we mean by duration? How will I calculate it? Now that I know that what the duration is going to do, the objective is clear. I want to protect myself from interest rate fluctuation risk. Now, the next question obviously is, how shall it be determined? What exactly does it represent? Okay. In capital budgeting, you must have done capital budgeting at CA Inter, isn't it? In capital budgeting, we have a concept of payback period. You remember payback period? Normally, capital budgeting discussion starts with payback period only. When we discuss techniques for analyzing capital budgeting, we go for payback period. You know what's the concept of payback period? Let us say the project cost is rupees 10 lakhs. And this project is going to generate cash flow after tax of, let us say, 2,50,000 per annum. Today I will invest 10 lakhs of rupees, and then every year I will be able to recover 2,50,000. So payback will be 10 lakhs divided by 2,50,000, which will turn out to be 4 years. Right? So if I am calculating the payback period, I realize that the payback period will be 4 years. What do we mean by that? By 4 years, we mean that whatever are the internal cash flows that will be generated from the project, those cash flows will recover the cost of the project in 4 years. Very similar to this, we have the concept of duration. Okay, very similar to this. We have a concept of duration. So in duration, what we do is we ask ourselves that what will be the bond price? What is the bond price? Let us say the bond is available in the market right now at rupees 90. Okay. Then I will find out that what are the internal cash flows of the bond. Once I invest the money, what will be the internal cash flows? Cash flows obviously will be interest and the principal sum of money, isn't it? These are the cash flows that will be generated from the bond. Now ask yourself, how much time will it take for the internal cash flows of the bond to recover the cost of the bond? To recover the cost of the bond. But one more thing we attach, which is not there in the payback period. Otherwise, payback period and the Macaulay duration, both of them will become the same. Okay. Here the argument is when we ask about the duration, I want to know what is the duration. Duration is how long will it take for this internal cash flows to recover the bond price, maintaining the original yield. This is important. The original yield should be maintained. For example, when I invested in this bond, I invested in the bond on the basis of an 8% yield. So when I invested in the bond, my calculation showed that I will get 8% return. Okay, 8% return. So now I will remain invested for a period equal to the duration. If I do this so, I will get my promised 8% return. Interest fluctuation, yields are going up or down, doesn't matter. I will get my 8% return. I become immune to interest rate fluctuations. Yields are increasing, yields are falling, I will get my 8% return. When I remain invested for a period equal to the duration. So as a concept, duration means how long will it take in years for the internal cash flows of the bond to recover the bond price, but maintaining the original yield. In our example, these are the internal cash flows. How long will it take for the interest and the principal sum of money to recover 90 rupees, which is the cost of the bond? How long will it take? But such that 8% return is available. That's the condition. 8% return should be available to me. So what will happen is if my calculations are showing, as I said earlier, the duration is 4 years. That means in 4 years, I will recover 90 rupees of my cost of the bond. I will recover 90 rupees of the cost of my bond, and I will also get 8% return. Since I've already got my promised return, I will sell the bond and exit from the bond. This is what I'll do if I want to remain protected, if I want to remain immune to interest rate fluctuation. So as I said, the concept is very similar to payback. Only thing is in payback, we do not put the condition of maintaining the same IRR. Here I put a condition that no, my yield should remain 8%. Yield is nothing but the IRR of the bond, isn't it? So I want that the 8% return should be maintained. Getting it? So the moment I know I have done my calculations, the moment I know that okay, this is the period for which I should remain invested. Now I can sleep well at night because I know that I'm not taking any risk at all, right? The risk which was there in the bond, which was the only risk respect to the interest rate fluctuation, that risk has been taken care of. Finally, how shall we determine the duration? What is the way of doing the calculation? Okay, I'll show you that now. When we were doing the valuations, year wise, we were taking the cash inflows. This we were discounting at the yield, right? So I'm saying at the yield, and we were calculating the present value. Okay. And then we were doing cumulative calculations. If you remember, if it is a 5-year bond, then for the 5 years, I'll get interest. And at the end of the 5th year, I'll get my redemption amount. I will discount it and work out the present value. This will be the final value of the bond, isn't it? So that will be the final value of the bond. But when you are calculating duration, when you calculate duration, you will go year wise. Please remember this thing. This is basically the first step of calculating the duration. Cash flows that will be generated from the bond should be identified separately for each year. Separately. No cumulative calculations will be done when you are calculating the duration. Okay. Then you will take the cash inflows. Let's assume that the cash inflows are 100 rupees. We are assuming face value of 1000 and let's say a coupon of 10%. So these are the cash flows that will be generated. Then I will put the present value factors. Okay, just consider that there are present value factors. And then I'll work out the present value. So present value will be determined by me. Now, the new point. We say that duration means how long will it take in years, isn't it? Just like payback period. We are saying how long will it take in years for the internal cash flows to recover the cost of the bond, right? That means we are basically calculating something which will be ultimately be in years, right? My final answer will be in years because the concept of duration itself is how long will it take in years, right? So what we will do is this present value that you have calculated, it should be multiplied by its corresponding year. Okay, it should be multiplied by its corresponding year. So this present value that you have calculated, it should be multiplied by 1 because this present value is for the first year. This present value which is there for the second year will be multiplied by 2. Similarly, the last one, I will multiply that by 5. So present value into year, present value of each year should be multiplied by its corresponding year. Okay, and then take the total. Also take the total over here. And now understand, because we are going to calculate it in years, basically it is a weighted average that you are calculating. So duration ultimately will be a weighted average. Tell me, how do you calculate weighted average? Forget about duration for the moment. How do we calculate weighted average? Weighted average is understood as total of weighted product divided by total of weight, isn't it? This is how we do the calculation of a weighted average. If you closely look at this particular calculation, you will realize that this present value you are using as weight. You are using it as a weight. Final answer has to be in year, not in present value terms. Final answer will be in year. So year is not used as weights. Don't be of the view that there's 1, 2, 3, 4, 5. Normally weights, when we calculate weighted average, we put weights as 1, 2, 3, 4, 5, isn't it? But that is not the weights over here. My final answer will be in years. So I am not using years as weighted average. I am using present value as the weighted average. Present value as weights. So this is basically total of weight, and this is the total of weighted product. Okay, this is the total of weights. PV is the total of weights, and PV into here is the total of the weighted product. Now this is the formula of weighted average. That's where I will get the formula for duration. Total of weighted product. So this is actually total of PV into year. Okay, divided by total of weights. Total of weight is nothing but total of PV. Okay, it is nothing but the total of PV. Now, one more thing. Here it is, the total of PV, isn't it? You are calculating over here the total of the PV. Now, earlier when we were doing this calculation, we were not preparing the last column. We used to say here, cash inflows will discount it and work out the present value. And this final answer that we were getting, we were referring that final answer as the bond value, or we can say the bond price. Yes. So that is what will be added further in this particular formula. I will say total of PV. That is nothing but the bond price. That is nothing but the bond price. This is how I'll calculate the duration. Step number one, identify cash flows separately. Step number two, discount the cash flows at the prevailing yield. Step number three, take a total of PV into year. How? Whatever is the PV. The third step is whatever is the present value, multiply that with its corresponding year. Once the three steps are completed, take a total of the PV column, take the total of PV into year column. PV into year is the weighted average and PV is the total of the weights. And that's how I get my duration. This is the final formula for calculating the duration. Total of PV into year divided by total of PV. This PV is nothing but the bond price. Final answer will be expressed in years. Whatever final answer you are getting, okay, whatever final answer. For example, I'm getting 2.95. I will say 2.95 years. That is the duration. How long will it take for the internal cash flows of the bond to recover the cost of the bond, maintaining the original yield? It will take 2.95 years, almost 3 years of time for us to recover the cost of the bond and getting our desired yield. And because I get my desired yield, now there is no interest rate fluctuation. What more? Yes, what more? So this is how I can work out the duration. Great. Now, I have invested, let me put it in this way. I have invested in a 25-year bond. And now I am asking you, calculate the duration. Calculate the duration, right? 25 years. So what is the first step? Tell me. First step, we have to identify the cash flows separately for every year. That means 1, 2, 3, 4, 5, so on. I have to go up to 25. Then I have to put all the cash flow information here. Then the present value, then the PV, then the PV into year. If I'm using an MS Excel worksheet, then it is fine. I can do this calculation very easily. But in exams, if they give you a 25-year bond and then they tell you that you calculate the duration, perhaps I will leave it in option. Obviously, I'll leave it an option. Who will write for 25 years? 1, 2, 3, 4. I'll have to go up to 25 and I'll have to put all the cash inflow information. Quite possible that 24 figures are the same, right? And then I have to put all the present value factor, then calculate present value 25 times. And then every present value multiplied by its corresponding year, another 25 times I have to do the calculation. Don't forget that total also is to be taken under exam pressure, okay? And then I have to work out the duration. I'm sure you will realize that calculating duration for a bond which has a long tenure manually can be cumbersome. Manually, it can be cumbersome. What is the way out then? There is a way out. Because we have what is known as a shortcut formula. If you want to calculate duration, we have a shortcut formula. Formula is not short at all. Let me give you the warning from the very beginning. Formula is not a short one, but still I'll consider this as a shortcut formula. You know what is the formula? Shortcut formula. Of course, everyone will like a shortcut, isn't it? So what's the shortcut formula? Just see. It is CY by YTM into present value factor at YTM percent for the tenure of the bond plus, sorry, it is multiplication, sorry. So into M into 1 plus YTM. It's not the end of the formula. Plus 1 minus CY by YTM into N. This is shortcut formula for calculating the duration, right? It's a shortcut formula if you want to work out the duration. If a bond for 25 years is given, Or if they are saying you have invested in a 99-year bond, calculate the duration, 99-year bond. Are you really going to do 1, 2, 3, 4, go up to 99 and then write down all the figures? Come on. Manually, it is going to be so cumbersome. I will use the shortcut formula and work out the duration. So this is the shortcut formula. In case if you are wondering what is CY, CY will stand for current yield, interest yield, if you remember. Okay, I upon MV into 100. You remember that? I upon MV into 100. This is what is the current yield. See, here present value factor is there, but they are saying YTM percent for n number of years. This I can do as a cumulative calculation. So if they'd given me 25-year bond, I have to simply find the cumulative present value factor for 25 years. Writing present value factors individually for 25 years will be cumbersome. But writing simply a grand total of the present value factors, that is going to be simple. So this is the present value factor that we will be calculating, and we will feed it into this formula, and it will give me the duration. If they are giving me a bond which has a tenure of 5 years, then perhaps the earlier detailed approach and even this approach more or less will be the same. It will take more or less same time, because in shortcut formula also I have to work out the current yield. For current yield, I require MV. MV is directly given, not given. A lot of things have to be considered when we calculate the duration. So if a short tenure is given, then perhaps I may not apply the shortcut formula. Maybe I do not apply the shortcut formula, and I may do the calculation as per the detailed approach. Detailed approach, for 5 years separately, I will write down the cash flows. I will discount it separately. See, for 5 years, I can manage it. But if it is a long tenure bond, 15-year infrastructure bonds, for example, are there for 15 years, available for 15 years, then I shall, what we can say, ignore the detailed approach and rather go for the shortcut formula, right? One another interesting thing is the duration of a zero coupon bond. This is very interesting. Duration of ZCB, zero coupon bond. Many a times they are also known as deep discount bonds. What happens in a zero coupon bond is something like this. Today, invest rupees 80. After 5 years, you will receive 100. Simple concept of ZCB. A zero coupon bond, as they are saying zero coupon, it will not pay any interest at all. Today, you have to invest a small amount compared to the face value. See, the amount to be invested as on today will be at a discount to the face value. That's the reason we even call zero coupon bonds as deep discount bonds. So I will invest 80 rupees today, and after 5 years, I'll get 100 rupees. Whatever 20 rupees extra that you are getting, you have to consider as if you got compensated for the interest, but every year you will not receive interest. The total amount will be received at the end of the tenure of the bond. Now, I want to know what will be the duration of ZCB. What is the concept of duration? How long will it take for the cost of the bond to be recovered by the internal cash flows of the bond? Now, in a ZCB, cash flow will be generated only at the end of the tenure of the bond. It is not like a regular bond. In a regular bond, what happens is every year I'm receiving interest. So since I keep on receiving interest every year, a certain portion of the price of the bond keeps on getting recovered. But in a ZCB, I will get cash flow only at the end of the tenure. Today, I invest 80 rupees. First year comes to an end, I don't get any money. Second year comes to an end, I don't get any cash. Third year, fourth year, so on. When the fifth year, once it is end of the fifth year, the bond gives me 100 rupees. In other words, I will get a chance of recovering the cost of the bond only at the end of the tenure of the bond. That's the reason duration of ZCB will be equal to its tenure. Never calculate duration of a ZCB. By observation, we will say. If they are saying that it is a 5-year ZCB, duration is 5 years. I will not do any calculation at all. Duration is 5 years. You get my point? Because only at the end of the fifth year I'll get cash. That means only at the end of the fifth year I get an opportunity of recovering the cost of the bond. So obviously the duration is equal to the tenure. But if it is a coupon paying bond, if I am receiving any interest, let's say it's a redeemable bond, and every year I am receiving some interest, then remember, duration will be always shorter than the tenure of the bond. Shorter. It will be shorter than the tenure of the bond. Why? Every year I am receiving interest, and because I am receiving interest every year, I will very soon recover the cost of the bond. For example, if the same bond is there, today we are buying it for 80 rupees, and then let's say every year we are going to receive some interest. Okay, so whatever interest I am receiving, let's say instead of 5 years it is 15 years. So every year some amount of interest has been received. So every year I'm recovering a part of the cost of the bond. Finally a time will come when I would have recovered the entire cost of the bond. This time will be duration, but this time will be shorter than the tenure of the bond. So in a coupon paying bond, duration will be shorter. How much you have to calculate that, but it will be shorter than the tenure of the bond. But in a ZCB, never do any calculation for duration. For ZCB, duration is equal to the tenure of the bond. And the final point to be discussed over here is duration of perpetual bond. Okay, duration of perpetual bond. Here we have a formula. The formula is 1 plus YTM divided by YTM. This is what will give you the duration of a perpetual bond. 1 plus YTM divided by YTM. If you want to be very elaborate, you can say YTM percentage. Use this formula, you'll get the duration of a perpetual bond. See, I'm just writing the shortcut formula over here. CY by YTM into present value factor YTM percent and number of years into 1 plus YTM plus 1 minus CY by YTM into N. This is nothing but the shortcut formula for duration. Okay. Now, CY is the current yield. It is I upon MV into 100. We are doing calculations for a perpetual bond. Ask yourself, how do we calculate YTM for a perpetual bond? If you recall that entire discussion, we had discussed this thing, that yield to maturity and a perpetual bond, they are two contradictory things. YTM means return that I will get when the bond will mature. Perpetual bond never matures. So technically, you just cannot have YTM for a perpetual bond. But practically, we consider return on investment to be the YTM. So for a perpetual bond, YTM is I upon MV into 100. In other words, for a perpetual bond, current yield and yield to maturity both are equal. See, formula is the same, so both are equal. So I'm just removing it. I hope you have understood this point. Both are equal. Now tell me what will happen mathematically. Both are equal. CY and YTM over here, right? Current yield and YTM both are equal. For example, if it is 10, then both are 10 by 10. That means I'll get the answer as 1, right? So this answer is going to be 1. You agree with me? Now anything multiplied by 1 is that same figure only. 2 into 1 will be 2. 3 into 1 will be 2. In other words, this entire term will be multiplied by 1. It will be the same figure only. So Whether I write this or I do not write this, it will make no difference at all, because ultimately it will be multiplied by 1. And if it is going to be multiplied by 1, it is going to be the same figure. Now, just see. Here what will happen? Cy by ytm is 1. So 1 minus 1, this will become 0. Anything multiplied by 0 will become 0. Anything multiplied by 0 will become 0. So I remove even this term also, because what is the point of adding 0? 1 plus 0 will be 1 only. So what is the point of putting that? In other words, in the shortcut formula, I am now left with only present value factor ytm percent n and 1 plus ytm. Here n is there. It's a perpetual bond. That means the bond will continue till perpetuity. That means till infinity. Okay. That means it will be till infinity. So 1 plus ytm is to be discounted till infinity, till perpetuity. 1 plus ytm is to be discounted. Now, in SFM, in SFM, anything that will continue till perpetuity, any annuity that will continue till perpetuity, if you want its present value, then it should be divided by the discount rate. I hope you remember this point. For example, if you are going to receive 100 rupees till perpetuity, forever and ever, you will get 100 rupees. And I'm asking you, what is its present value? Now, 100 should be divided by the discount rate. Whatever answer you are getting, that is its present value. So my discounted over here obviously is yield to maturity. So 1 plus ytm is to be discounted till perpetuity. I should divide that by the discount rate. So 1 plus ytm divided by ytm. This is what I get. And that is nothing but my formula for duration. If you see the formula for duration of a perpetual bond, this is what we are getting. Right?
Press the bell icon on the YouTube app and never miss another update.